Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
Reality radio for a really great future. We're talking real money.
Hey, welcome to our little weekend get-together that we call Talking Real Money. Thanks for getting together with us, me, Don McDonald, him, Tom Cock, in the iced-over ADU. And we're here to talk with you about the things that you do with your dough every day of your life, pretty much, because you know you deal with money a lot. We want to make it easier for you. We want to make you feel better about investing and saving and maybe even spending your money better than you did before. 855-935-TALK is our telephone number. That's 855-935-8255. We had a very busy holiday hour last hour. Or
that was awesome.
Last
Keep them
podcast.
coming. Keep that giving mood going.
Apparently, you guys have eaten enough. You've shopped enough. And
you left the drinking enough thing out, apparently. That would have been first.
Yeah, well, you don't want to drink too much. Although, oh my gosh, I was at a friend's house. They had a big Thanksgiving get-together with like 50 people outside.
And what did you show up with? What did you bring?
A pound cake and some
That's
green beans.
it? That's all you had to cook
beans.
on Thanksgiving?
That was it. And I went in the house after a while because it was outside under a tent. And I went into the house, and the host, a friend of mine, had a big old bottle of Woodbridge Reserve or whatever.
Now you're warming my soul and my guts.
He goes, You want a Manhattan? And I went, okay. And he mixed the best Manhattan I've ever had.
That stuff, though, just a little ice and
high end.
Happy.
Oh my God!
Yeah.
No, he put the one big ice cube in. The big ice cube.
Yeah, but I don't need anything with it. That's just
that was good.
Tasty.
Anyway, so if you've drunk yourself
holidays.
into a stupor, or eaten yourself into a stupor, or shopped yourself into a stupor, now it's time to straighten out your financial life before the year's over.
Snap out of it.
By calling us here at Talking Real Money at 855-935-8255. Now, we have said, as has Dr. Bessenbinder at Arizona State University, we have said over and over again that you are not likely to do well trying to pick the best stocks.
No,
so,
his research points out that there's a very few stocks that made most of the money for the last basic 100 years.
Yeah. And
if you don't own those, you're in trouble.
That is obvious. That is blatantly obvious when we look at the performance of the S&P 493.
Which,
you know what that is?
Do we have the trademark pending on that one? Is that
you know what the S&P 493 is?
Yeah.
That's the Standard & Poor's 500 minus what are called the Magnificent Seven.
Alphabet, Amazon, Apple, Meta, Microsoft, Tesla, and NVIDIA.
Ooh, you know that. You memorized that.
No, I wrote it down because I forget one of them, as I always do.
So if you own the S&P 500 from 2019 through, what was I want to make sure I have the through date right. Oh, through current. Yeah, through last week.
The end of last week, yeah.
You would have seen a return of 1,057%. Over 10 times your money. Over 10 times your money.
In the last 6 years.
In the last 6 years.
Wow.
Yeah.
You just had to know in June of 2019 to just sell everything else and only own those 7.
However,
NVIDIA had just been a video game supplier or something at that point, right?
However, if you just purchased the S&P 493 and skipped those 7, this tells you how powerful a few stocks can be.
Yeah.
You would have just over doubled your money. 132% return.
1,057 versus
132. What does that tell you?
When you told me about this, not much. I mean, because I said, how do I respond to this? I don't know how to respond.
No, how you respond to that is, did you own just those 7 stocks?
No, I own all of them.
Right, you own all of them. Now, the problem is, what happens when those stocks are not the hottest stocks in the S&P 500? Let's go back. Shall we go back a little bit? Let's go back to 1985. Let's look at, hold on, I want to get the 10.
1985, and you're going to look at what the
best performers in the S&P 500 in 1985. It was none of these stocks, by the way.
No.
It was none of these. The number one returning stock, the magnificent one, really, it beat everybody by a
IBM?
huge margin. Huge margin. You'll never get this one.
I said IBM.
No. It had nothing to do with technology.
No.
Nothing whatsoever.
Boeing.
If you thought about canned meat, you might have gotten it right. Hormel.
Because spam is so big. No, that is a tech company because they issue spam, right?
Yeah, they do. Hormel in 1985, just that year, rose 1,700%.
That was stuff they ate in World War II or something.
1,700%.
That just makes literally no sense.
Wait.
What, they just find Hawaii to start selling the stuff to, or what happened?
And among the other best ones that year, none of Lowe's Corporation, which is a hospitality and theaters.
Lowe's, not the hardware.
No,
people.
not that Lowe's. Yeah. Dwight and Church, which is like a consumer goods company.
Yeah. Mm-hmm.
Franklin Resources, Raymond James Financial.
Of course.
These were the best back in 1985. These have all fallen from grace dramatically since then. So,
I want to come back and talk about what you need to own in addition to the 493 too.
Right, because you need to own not just them, the 500, but you need to own some other things. 855-935-TALK is our phone number.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Okay, you set something on fire in here. It's
getting chilly. 855-935-TALK is our phone number. Now, Hormel Foods in the 1980s returned almost 19,000% over that decade from 1980 to 1990. Good year. But one company did better over the 10 years from 80 to 90. Yeah.
Microsoft?
McDonald's.
Huh?
24,000% over
in the
10
80s?
years.
Wow.
And let's look at what their current 10-year return has been. Over the past 10 years, 246%.
They just supersized things in the 80s no longer, I guess, right?
What the message, though? It's
the message
is you can't pick them. Would you look, if you stayed in McDonald's the whole time, you would have had a great 10 years, but you would have had a mediocre period after that.
And your arteries would have been too hardened. The thing is, okay, but let's just finish this thought, because in addition to the 493 and the 7 that we're going to recommend, we also want you to own some other things, right? You got to have some smaller companies. You got to have some value companies. You got to have some international. You got to have some other stuff in addition to that. And Besson Binder is correct. The research is clear. You can't pick the right stocks. You got to own them all. And you can't try to predict what could be best next, because gosh, even in the 80s, I would never have predicted McDonald's because it was so popular in the 70s.
Yeah,
Who would have thought the stock would go
Hormel.
that way?
What Hormel
Right.
wouldn't have even been on my radar.
Exactly. Yeah.
Well, it was actually toward the end of the 80s. Everybody was buying Hormel because, well, it was doing so well. No, it had already done.
There used to be a guy with Dimensional Funds who did a piece about owning Hormel, which no one would have done in that period, and owning.
Oh, Weston did that, yeah.
And it was the tech company, the phone maker that based in Phoenix. I'm drawing a blank right now because I don't even think they make phones anymore, but cell phones. They're among the first to make cell phones. Motorola.
Yeah, it was Motorola
Phoenix,
versus, but Hormel.
It was a great piece because you're like, I'll go with the tech guys. I'll go with the phone thing because that's big. But no, it wasn't.
Nope.
It's fascinating.
It was the pork.
Anyway.
There was the beef. 855.
Wait, have you ever had Spam? Have you ever eaten
I
it?
have had Spam when I was a
No, I've
kid.
never had it.
I've never had it. Yeah.
No,
It's
I've never.
when they talk about salted pork in the history books. You've read about people's armies surviving on salted pork.
Yep, makes it last.
That's that is Spam. That is the epitome of Spam. It is salted pork.
I think it's still popular in Hawaii because it gets there easily and it doesn't need to be refrigerated on the way, if I remember right. So
it never needs to be refrigerated.
It's never's the right word with me and Spam. I'm old enough now. I'm never going to have to eat it. Sorry, Spam.
855-935-8255. If you call that number, we'll have a conversation. And it's kind of fun. Let's go to Puyallup, Washington now. And Mark, you're on. Welcome to the show.
Hi. Thank you, Don and Tom. I appreciate it. I've got a question because I've heard you talk about if you retire early, and let me just throw out, let's say 56, that if you decide to tap your 401k, that there are sizable, you have to do some sort of sizable distribution each year and it's scheduled or something along those lines. And my question is, if you were to, per se, be 56, decide to tap those prior to 59 and a half, is there a strategy if you also, let's say, have like a Vanguard traditional IRA to, prior to retiring from your employer, to move some of that money from the company-sponsored 401k plan into that IRA so that then that sizable distribution would be less? I'm just kind of, I don't know why that popped in my head a few weeks ago, but it did, and I've been meaning to ask you.
I pointed to you.
No, you pointed to me. Yeah. Okay, here's the thing. So, but just to go back to make sure we're all on the same page. Anytime you take money from a qualified plan like a 401k, IRA, et cetera, before 59 and a half, you're going to pay a 10% penalty on top of the taxes you're going to pay anyway. Except.
Right. I was going to say there's an except in there.
There's an exception. That's what you're asking about.
Yeah,
you can set it up so you take an even amount for a period of years and you don't pay the penalty. You're still going to pay the tax. But moving that to an IRA is not going to change anything.
No, you could do it either way.
You can do. You're going to face the same thing with the IRA or the 401k. There's no escaping.
So if you have a company-sponsored 401k plan and an IRA, they're going to look at both of those as far as your what you're taking out.
If you start to pull money from them,
yes.
Well, I'm kind of asking if you were only pull from the company-sponsored 401k.
Then you're only going to pay. You're not going to pay on the IRA. No, that's still going to sit there,
but
you're saying.
Your distributions have to be substantially equal periodic payments, or what they call SEPPs.
Now, but what he's asking about is if he has an IRA that's separate from the 401k, and he can take it from one of them and ignore the other.
He can take it from one or the other. It doesn't matter.
Yeah, that's
it doesn't
fine.
matter from
They're
which one you take it.
So would there be a strategy then if you, per se, may want to tap your one of those accounts to move some of that money to lessen that account, which would then lessen that sizable distribution?
No, because the tax treatment is the exact same for either account.
So wait, so just so I'm clear what you're saying, Don, they're going to add the whole thing up.
Yeah.
So you have to take out an even amount of all the pre-tax money you saved.
all the pre-tax
So it's
dollars.
not going to matter. Yeah, that I wasn't sure on.
Yes.
Okay, so they will look at, if you just say, I want to tap my 401k, they're going to look at all of your accounts and say, this is your total amount, and that's what we're basing it off of?
That's my understanding. Yes, sir.
Yeah, I don't know that, but I'll go with Don. Knows all. I'm just the fatuous, silly guy, so I'm not sure,
again, that was my understanding. I'm going to do some more research here just to make sure, but I'm pretty darn sure people would be switching all over the place.
He'll have to come back and tell you after the break.
855-935-TALK is our phone number. Don't go away.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
All right. I read during the break, I skimmed through 72T.
Let's go back and just describe the situation so everybody's aware of what we're talking about.
Okay, good. Go.
Yeah.
Oh, I
okay.
will.
So
you do it.
Retiring prior to 59. At 59 and a half, you can start taking money out of any of your retirement accounts. You're going to pay tax on them.
But no penalty.
If they're pre-tax, but no penalty. Mm-hmm. Before that, penalty. But you can 10%. Do the 72T even.
Yeah, here's the deal.
But.
Okay.
Yep.
Yes, you can take it from either account.
Yep.
The 401 or the IRA. And only that account is the number that applies to the size of the distributions that are based on a number of different formulas. The IRS has different formulas for determining what that SEPP amount is.
So Mark is correct. You could transfer a bunch to one of them.
You need to be really careful. You need to make sure that the one into which you transfer it has everything you're going to need in it, because no changes can be made after the fact.
Locked out. You're done.
Once you've started to take your SEPs, your substantially equal payment plan, you cannot make a change. That if you make any change to the accounts, then you will get hit with the 10% penalty retroactively.
Okay. So, Mark, you were correct. You can move a bunch of that money over, and you would save. Yeah.
You would save. Absolutely.
What are you going to do at 50?
Hey, some people want to retire early. That's okay.
You want my lawn contract?
Yeah. I mean, I was actually, Debbie and I were talking, and we were talking about maybe, doing some sort of a trip. I had wanted to, go to Europe over Christmas.
I want you to come to Hawaii with
none
me
of the
because,
kids are
somebody's got to carry the bags and stuff. So
yeah, but then who's going to do the show?
That's a good point.
If
everybody's out of the office,
who's going to do the show? I can't go anywhere with you.
That's a good point.
Yeah, unless we have the tie line thing. But anyway, we were talking about that, and she said, yeah, but it's expensive. I said, yeah, but you need to do this stuff when you're young enough to enjoy it.
Thank you. While you still feel up to it.
Yeah, because I'm telling you, the way my knees hurt now at 69,
yes,
I mean, 79 could be, walking around Europe could be trouble.
Yeah.
And, oh, my gosh, a friend of ours told us about this airline flying out of Newark, La Compagnie or something. It is all lay-flat seating, the whole plane. They fly to Milan.
Yeah, but how much more is it?
It's like $3,000 round trip.
And this is from Florida to Europe.
It's only out of Newark.
Oh,
and they fly from Newark to Milan and maybe it's Paris. I can't remember for sure, but it was only those two places.
Once you get there, you can go anywhere, though.
Well, yeah. If you can make it there, you can make it anywhere because they have trains in Europe.
They do, that run on time.
Unlike the trains we don't have in America, except for Florida. You have
high speed?
We have maybe the best rail service in the country between Orlando and Miami.
Yeah, I mean, this is the time of year. Everybody should be heading south, right? And by the way, I just read this the other day.
Trust me, they're all here. I can look outside.
Do you know why birds fly south for the winter? Do you know?
Because
I just read this the other day.
It's colder up north.
Nope.
Because it's warmer down south.
Nope. It's quicker than walking. That's why they fly.
God, that's out of the bad dad joke book. It was.
I got to credit somebody first. Somebody sent me a whole bunch of them the other day, so thank you for those. I'll leave the one
don't
right for now.
encourage him.
Sorry. I love that one. I really do.
Because it's quicker.
I've been using it all weekend. So
I don't know. Their wings get pretty tired.
I'm just handing out the information, my friend. That's it.
How do ostriches get south for the winter then?
Checking the veracity. We haven't been to an ostrich market for a while, but it's coming. Where everybody's going to stick their head in and say, "No, I don't want to look. I don't want to look." So,
what is an ostrich market? I thought maybe it was a place where you buy ostrich eggs.
You bury yourself.
Or ostrich
you bury
meat.
your head in the sand.
Ground ostrich.
I seen them. 2020, 22, 08. 2000.
All right. Our phone number here is 855-935-TALK, 855-935-8255. Give us a call, or you can do like a lot of people do and just go to talkingrealmoney.com and record your question or type it in. And I have a couple recorded ones. You want a recorded one?
Yeah. We'll
sure?
do one of those, and I've got some typed
Oh,
ones.
we'll wait until the next segment.
We're out of time.
Yeah, because it'll take almost to the bottom of the hour to get this one in. So we'll just skip that until then.
Yeah, we'll hear more about your potential trip.
Well, there isn't a potential trip because
I know.
The problem is not. It's not. You know what our problem is we have 2 dogs.
Yeah, you could bring the dogs here. By the way. Set up here in the ADU. It's very nice this time of year.
Long
it's like
way.
48 degrees in here. I know.
It's a long way to take dogs, and we needed a dog sitter.
You could do the show from right in this studio, too, right here.
No, it's too cold in there. You won't turn the heat on.
I'm only surviving.
Give us a call, 855-935-TALK. It's so easy.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hello again. Welcome back to our program. 855-935-TALK is our telephone number. That's 855-935-8255. I'm Don. That's Tom. And let's go to Seattle. Craig, welcome to the show.
Hey, guys. How's it going?
Good.
Good. Glad to hear it. Well, no shocker. I want to talk about Avantis. As we've talked about before, my 2 largest holdings in all my accounts are AVGE and then AVGV. And the more I'm looking at it for my brokerage account, and it's about 30% of each, and then, I've got some other things. But the more I'm looking at it, I'm wondering if it's feasible or what you think of AVGV as a primary holding, replace AVGE, just have 50% AVGV, 40% AVMA, and 10% of the AVNB that we talked about last week. So I've got all of my bond, my small cap value, my international covered. I haven't heard you dig into AVGV very much, so I'd like your take on it.
Well, AVGV is a new child.
Yeah.
AVGV is newer than AVGE, but it's just the value.
That's their value tilt.
It's a heavier.
Yeah.
AVGE already has a value tilt.
Yeah, I don't know that I'd be advocating a greater. I have not spent that much time with this fund, so I will say that frankly. Number 2 is
that's part of the reason for the call. I was hoping you would.
And I don't know that I would swap them out one for one. But you mentioned something about another fund and then went so quickly.
AVMA, was that the one?
Yeah, I was going to have that be about 40% of the brokerage. AVGV is 50, and then AVNV as the other 10% that's pure international value.
AVNV. Well, envy's a bad thing when it comes to investing because that's how people get in trouble.
That's what you said last week.
So you said the same thing last week. You used the same joke a week ago.
I don't think I used that joke.
He said you used the same thing.
It's still hilarious, though.
Yeah, still hilarious, though.
He's
He's kissing up. He's
grinding his teeth.
I would not. I got to tell you, I really thought about this when I saw it on the screen. I know that if Paul Merriman was here, he would say go with AVGV
because that's an all.
It's heavier value
portfolio,
it's an all
but it just
equity,
has a greater value tilt.
And it is substantially greater value tilt. It's a pretty high additional value tilt, and it's a slightly smaller tilt in addition to value.
What's the expense ratio?
Their AVGV.
By the way, just so those of you who are not in the inside game of Avantis, these are all funds from a firm called Avantis. It's owned and operated by American Century, and they have been a competitor of dimensional funds now for
AVGV, the value ETF, is 0.26, and AVGE is 0.21.
So they're relative.
0.23. I'm sorry, 0.23.
0.23.
So they're very, very close. Are you driving a wrecking ball or something? Are you
hitting something?
Are you like pile driving on the highway?
You got me out of my wrecking ball.
Yeah. It's like
You're breaking up the hodgepodge. Well done.
I got to tell you, if for somebody who wants to take a slightly more aggressive approach, and I love the fact you're adding a little more international, I would not be opposed.
I think you're overthinking this. This is the difference between prime rib at 120 degrees or 125. It's going to be okay either way.
Okay.
Okay.
That is what I wanted to know. I appreciate it, guys.
Thanks, Craig. Appreciate the call.
That's kind of
go drive those piles.
Yeah, no, that's an interesting thing, though, for Avantis to roll out a product that has a greater value tilt. I mean, because it's going to have periods of big underperformance because value.
If this fund existed over the last 10 years, 15 years,
10.
it would have been a dramatic underperformer. Yeah.
I mean, they may be setting up perfectly for return to value, but who knows?
If the two of them existed over the last 10 years, AVGE would have cleaned its clock.
Yeah. So it's kind of I mean, I guess if I had to pick, maybe you could have half in each one, but still you're going to have a lot of overlap. It's not going to be dramatically different, but I'd have to hear from them. That'd be a question we can ask them, when they come out in March for retire meet.
But I'm pretty sure,
I need that fund?
Knowing Paul would say, yeah, go for the higher value tilt.
Well, he'd like the smaller, too.
And the smaller small.
Yeah, sure.
It's really easy, though, for them to do that because both of these are funds of funds.
Yeah.
So all they have to do...
they hold a bunch of other ETFs, yeah.
All they have to do is just up the large cap and small cap value portions of that portfolio a little bit higher than AVGE. It's
but why do they need
easy.
to do this? Why?
Because there are value fanatics. Small and value fanatics.
So it's not enough to have the value that because it's overweight. So if you looked at the market in terms of the market capitalization, they're already overweighting the exposure to small and a value. Yeah. So they're just saying, we'll even do it more now, okay.
It's just trying to please all of the people all of the time. There's another word for it. It's much shorter than that phrase. It's called pandering.
Yeah.
It's a pander play.
Well, no, we'll ask
Not
them.
a panda play, but a pander. Oh, they won't admit it's a pander play. Yeah. But that's what we all tend to do.
But I want to know who they have already told me on several occasions, Eduardo, that most of the business comes from investment advisors, right? Mm-hmm. That very little of it comes from the public directly.
Yeah, but
why does an investment advisor need this one and AVGE if they're going to use one fund at all?
Right, you use one or the other, really, and it just depends on what you're shooting
odd, that's
for.
All.
They're both value small blends.
Yeah, that's right.
With they're a blended fund with a value small tilt slightly. It's and the expense ratios are so close.
Yeah.
And the U.S. international split is
how much?
I believe it's the same. Let me just double check. So it's 70-30 on AVGE. Oh,
70% U.S., 30% international.
Yeah, it's 60-40 on AVGV. Which makes me like it even more.
I figured as much, Mr. 50-50. Loving those foreign stocks, are you? Huh?
Well, guess what? We have a couple of lines open for you on this Thanksgiving weekend or week after Thanksgiving. 855-935-TALK is the number to call on Saturdays.
Tom and Don are talking real money.
Hey, Ryan Reynolds here. Wishing you a very happy half-off holiday because right now Mint Mobile is offering you the gift of 50% off unlimited. To be clear, that's half price, not half the service. And Mint is still premium unlimited wireless for a great price. So that means a half day, yeah? Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And our favorite thing of all to do. No, it was not eating turkey and pie. I didn't even have any pie.
I'm going to make turkey tetrazzini tonight. Sounds good.
You're just making stuff out of the leftovers. You got that much turkey left,
huh? I got a lot of turkey.
Got a lot of turkey. Yeah, he is a lot of turkey. 855-935-TALK is the phone number to talk turkey with us or money. Either one works for me. I don't really care. 855-935-TALK. But remember, you can also anytime, not just on Saturdays, get in touch with us, ask us questions by going to talkingrealmoney.com and clicking on the Contact Us button. That allows you to speak your question into your computer mic. Like this is my computer mic right there. That's my computer mic.
Sounds good.
Well, it's a Neumann. Neumann makes the very best microphones. They really do.
I'm inclined to believe you, having not
really
any
do.
expertise in this area.
They're the best. So you can also type them, though, and Tom gets them, and his paper pile is growing.
Well,
low.
no, this one's not paper. You're gonna be
what? You're going to read a question off your phone?
I know.
No, this never happens.
This is
never.
Wait till I see my therapist next
it?
week. He's going to be so happy.
Can you see it that
so
well?
Happy. Not well.
All right.
But I wanted to read this one. It just came in a couple of yesterday, and we have others from before. But I'm going to break. Protocol is that I read them as they come in. But this one was so timely because Sarah took the time to write us from San Antonio, and she says at the Thanksgiving table, a relative was talking about investing and made a big deal about dividends. He proceeded to look at my portfolio, VTI, VXUS, and VT Sachs, and right away looked into the dividend payouts. He saw that my total global international fund had an erratic payout, and he says it's too erratic. It means it's not a good fund. I'm totally lost, confused, and now doubting myself. What are your views, number one, on dividends? Number two, are they a measure of how healthy a company is?
No.
Number three, how important is it in the world of investing? In other words, should you dump that fund because it has an erratic dividend payout?
Okay. Let's talk about dividends. Dividends are generally something that a company makes to make itself appear more valuable to an investor. Generally speaking, a great company, a truly great company that is creating high returns for its investors reinvests in itself. They take the earnings that are coming in and they go, we're growing at an internal rate of 20 or 30%. Why would we pay our money out to investors who could only then reinvest it at 7 or 8%? We put it back in the company. It's better for our investors because we're making so much on ourselves. So that's why you see almost all high growth companies pay no dividends. None whatsoever.
Famously, some very large tech companies just said, no, we're not doing it.
Right. Because they make more money on their money than you're likely to make getting it out as a dividend. So the dividends are nice, but there's this. I swear there must be some big influencers out there, finfluencers or something online, pushing the dividend play.
Then people believe it's something for nothing, which it's not, because the price of the share readjusts when they issue dividends anyway. So you're not getting some free lunch. Part two is I think I read this recently. It's only about 60% of companies issue dividends. So if you try to reduce, only go into high dividend paying stocks or funds for that matter, you're really eliminating the one advantage you have on Wall Street, and that is diversification. And number three, there is no guarantee that dividends being paid out, back to the erratic part, that people will continue to pay out dividends, that they can pay them at whatever. There's a bunch. And sometimes companies can look like great dividend payers, but people forget the price has gone down a lot. So it looks like it's a great deal, but it really isn't.
And dividends are kind of counterintuitive. Some of the highest dividend paying stocks are the stocks that are in the most trouble, the companies that are in the most trouble, because their dividends are high as a percentage of their price because their price has been hurt by problems with the company. The market doesn't want to own them. And the other thing is that companies usually have these great dividends when they're in trouble, and then they cut them. I think that's what the person's referring to. Is they're thinking on an individual. They have their mind is geared toward individual stocks. That if a company had erratic dividends, that means it couldn't afford to pay them. But these are funds. Their dividends have nothing to do with the quality of a single company.
Well, I'm glad you brought up the source of the information. I'd like to know who the source is. And I'd refer that source to people that I think you could. Larry Swedrow's written a couple of great pieces on why seeking out high dividend payers is not a good strategy long term. Yeah. And Larry's somebody I think you can listen to. I'll put it that way.
Another reason people like dividend strategies, there are a lot of old school investors who like them. The value people like Ben Graham and Peter Lynch, people, they were, buy high dividend. It's saying that a company's of high quality. It doesn't really say that anymore. Amazon, I don't think pays a dividend. I don't think Alphabet pays a dividend.
Correct.
Apple barely pays a dividend.
They have they ignored it for a long, long time.
Yeah, but it wasn't until, I think, 10 years ago they started paying a dividend.
That's about right. Yeah, right.
So,
that's about right. So, yeah. Those are companies you want to own, by the way, just so you know.
Dividends are unnecessary. You have a massively diversified portfolio, and I bet if you laid your portfolio up against his, you own hundreds, if not probably thousands of stocks more than he owns.
Those funds that she mentioned.
Well, but based on what I don't know what he owns, but
yeah, no, that's true. But again, the thing is, what we always want is massive diversification. We want balance of some degree between U.S. and international, and we do not want you picking stocks. I don't care how great a dividend payer or whatever else they are. Do not pick stocks. It's not a good path.
There's a curious thing about conversations this holiday season. There's always somebody at the table who's a know-it-all. That's your know-it-all. And he doesn't know what he doesn't know. And he doesn't know a lot. 855-935-TALK is our phone number.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
Oh, Tommy, it's me, the tree fairy. We just wanted to tell you how much we appreciate you reading from your phone.
Nice. Thank you.
Well, the trees appreciate it because you're saving us. Now,
I know.
Did you really eat one of those sweet little turkeys?
Let's not talk about that. You're going to be upset with me, so let's not ruin the holiday. Yeah, I know. Sorry. Nice of you to drop by, though.
The tree fairy dropped by.
I know.
Oh, my gosh, how sweet of her. She wanted to, I think that was nice.
Yeah, it was nice.
Hey, you can call us just like the tree fairy did at 855-935.
If you sound like that, you might not get through
She
the
has a really good phone. That was a great phone. 855-935-TALK is our phone number. And as I said, you can you can type your questions to Tom, and he'll read them on his phone now, or you can speak them through your little fairy microphone like this.
Hey, Tom and Don. My 401k at work is run through Fidelity, and the wealth management team contacted me about managing half of my portfolio, which I would roll over to them. And they was wanting to charge 1.24%. And I didn't think it was worth it because I have a good broad mix of funds to choose from now. Curious what y'all thought about it.
Yeah, I'm curious how they can get away with that.
I looked it up, by the way.
Well, no, not just the cost, but the fact is, if you're managing somebody's plan and you tell them, by the way, it'd be better if you move it over here, compliance isn't going to like that very much.
Well, I don't know that compliance cares, but I think the clients...
Well, they should too, but I'm just saying that's an odd thing to tell people.
But I looked up their fee structure, and that is correct. Fidelity charges 1.24 plus the funds.
Yeah. So
we think that's too much.
Yeah, I do.
We think, particularly for this, this being not a gigantic account, I think yours is I'm guessing, looking at the fees, I'm guessing he's around $1 million. That's after break points, by the way, Tom.
Wow.
Yeah.
It was higher.
They're high. That's just too high.
Yeah.
I would be opposed.
And always back to the fee situation here. If it's truly just for asset allocation.
That's basically what it's for.
Yeah, I think paying that much is way out of line. I mean, paying one, and people are going to say that's self-serving, but when you pay one, you should get financial planning. You should get tax help. I mean, there's all kinds of things that should go with that. It's not just putting together a portfolio and then we'll see you later. So that would be another question I have. But I'd also ask them, wait, you manage our plan at work. Isn't it okay? Isn't it of high quality?
Yeah.
Why do I need to move the money?
Isn't our plan at work good enough?
Why would I need to do that? It seems rather strange. So, anyway, fair enough. Good question.
And with that, we reach the end of another episode. Thanks so much for being a part of our little get-together. And please tell a friend or two. Go to talkingrealmoney.com and send us your questions. We love those. And you can also, it's a good time of year to get a little bit of free help with your portfolio so you can, like, de-hodgepodge-itis it or whatever. Go to talkingrealmoney.com and we'll set you up with a meeting with one of our fiduciary advisors for free for nothing with no obligation and no high-pressure sales pitch. That's talkingrealmoney.com. Click on the button that says Meet an Advisor.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.